Welcome to Iron Financial, where we look for steel in the rubble. Today, we're digging into Alcoa, a company the market has, well, left for dead after its latest earnings report. The big question is, are they right? Right? The market's not just right, it's screaming. A 6% drop in a single day is a massive vote of no confidence. You're telling me there's something that thousands of traders and, I don't know, billions of dollars in sell orders completely missed? Come on. You know, the market saw a surface crack and ran. We don't run. We bring the tools, and we check the load-bearing columns. We analyze the architecture. The market, it just sees the graffiti on the outside wall. Okay, I get the metaphor, but a 6% drop is a lot more than just graffiti. That's a real reaction to the headline numbers, which, let's be totally honest, looked weak. Billions in market cap just poof, vanished. That's a powerful signal that something fundamental is wrong here. And this is what the market missed. While everyone was panic selling based on the top line, this number was just humming away under the hood. $425 million. That's the net income for the quarter. It's like the engine is roaring while everyone is staring at a tiny dent in the fender. Whoa, wait a second. A 99.5% sequential increase in net income? How does a company practically double its profit from the quarter before, yet the stock gets absolutely hammered? This is the contradiction. It makes zero sense. The top line missed, the stock plummeted, and yet the bottom line exploded. Which one is the real story? Exactly, that is the question. And the answer is what separates the steel from the slag. It's exactly the kind of disconnect we live to find. The crucial point isn't just that it happened, but why it happened. So let's dive in and deconstruct this whole thing. Okay, first, let's just look at what spooked the herd. The top-line numbers did not meet Wall Street's expectations. And in this twitchy, headline-driven market we're in, that's all it takes to trigger a massive sell-off. The algorithms are coded to react to headlines, not to dig into the footnotes. They saw the word miss, and the sell orders just flooded in. Right, there it is in black and white. You can't hide from these figures. Revenue came in at $3.19 billion against a $3.3 billion estimate. That's a miss of over $100 million. And adjusted earnings per share missed by 7 cents. From a distance, this company just looks like it's struggling. They aimed, they fired, and they missed the target. You can't just explain that away. On the surface, you're absolutely right. The market is a momentum machine. It saw miss and it sold. But the real story, the structural integrity of the business, is never in the headline. These figures are the drywall. We're here to inspect the steel beams behind it. So let's deconstruct that revenue miss. Where did the weakness actually come from? Was it a collapse in demand, or customers walking away? Or was it something else entirely? The answer is the key to this whole story. And you know what? It all comes down to one simple word: shipments. Okay, a 31% sequential drop in alumina shipments is massive. You can't just brush that off. And on top of that, an 8% drop in aluminum. So I have to ask again, is this a collapse in demand? Are customers canceling their orders? Because if that's what's happening, this isn't some little surface crack. This is a sinkhole opening up right under the company's feet. It was not a demand issue. And that is the most important distinction an analyst can make. This was the perfect storm of logistical nightmares. We have to separate these temporary headwinds from what could be permanent structural damage. The question is, can they sail through it? The list of causes here is what's so interesting. The CEO was crystal clear. They were managing impacts from the conflict in the Middle East, which has thrown global shipping into total chaos, and Cyclone Narelle in Australia, which directly impacted their operations there. These are serious external logistical logjams. This isn't a lack of customers. Then you add in some planned inventory moves in North America and the usual seasonal slowness, and yeah, you get a top line that looks far weaker than the underlying business. So, a cyclone and a war. Are these just convenient excuses or a legitimate reason for a miss of over $100 million? It sounds like you're saying the core business isn't broken, it's just stuck in traffic? Precisely. Management stated they fully expect to realize these shipment impacts in the second quarter. This is a timing issue, not a solvency issue. The revenue didn't just evaporate into thin air, it just shifted a few months to the right on the calendar. The market punished them for a delay, not a deficit. Now, let's get to the engine room. This is where the story gets really interesting. While the top line was getting hammered by all those shipment delays, the bottom line was quietly exploding. The market fixated on the weak revenue and totally missed the incredible strength in profitability. These numbers are the complete opposite of the revenue story. Net income is up 99.5% from last quarter to $425 million. Adjusted EBITDA, a key measure of cash flow, is up almost 13% to nearly $600 million.
How on earth did costs fall so dramatically or prices rise so much to create this kind of profit explosion while shipments were literally falling off a cliff? This is the core of the contradiction, because it's a story of two completely different businesses operating under one roof. The market treats Alcoa as a monolith, but you have to split it apart. You have to analyze the alumina segment and the aluminum segment separately. One is bleeding cash, and the other, well, the other is an absolute mint.
This right here is the tale of two Alcoas. On one hand, you have the alumina segment. It got pressured by lower prices and rising costs, and it posted an adjusted EBITDA loss of $40 million. On the other hand, the aluminum segment was a cash printing machine. It benefited from high metal prices and premiums to generate nearly $700 million in adjusted EBITDA. Wow. That visual is stark. I mean, it's not even close. One division is basically drilling for debt, while the others struck gold. The aluminum segment is carrying all the weight, and then some. So what's driving that massive performance? How are they generating so much cash when the other half of the business is losing money hand over fist? It really comes down to two things: price and premium. The global benchmark, the London Metal Exchange aluminum price, was up a strong 10% sequentially. But the real story, the hidden alpha, is in the regional premiums. And this is where it gets fascinating. The very same supply chain chaos from the Middle East conflict that hurt their alumina shipments, well, it lit a fire under aluminum pricing. Yeah, the same conflict that's gumming up the works for their alumina shipments is creating a bidding war for their alumina. It's a classic case of supply and demand. Just look at the surge in regional premiums since February. Rotterdam Duty paid up 55%, CIF Japan up a staggering 104%. Alcoa, with its global footprint, is uniquely positioned to capture this upside. The market turmoil that hurts one part of their business directly benefits the other. It's a strange but incredibly powerful internal hedge. Okay, I'm following. The income statement is a mixed bag for sure, but the aluminum segment is the hero carrying the company. I get it. But a strong house still needs a solid foundation. So what does the balance sheet look like? A profitable company with way too much debt is still a ticking time bomb. And I saw a number in the report that made my blood run a little cold. And here it is, the Altman Z-score. For anyone who doesn't know, a score below 3 is a warning sign for potential bankruptcy risk within 2 years. A score of 2.28 isn't just a warning, it's a big, flashing red light. So while you're celebrating the engine room, is the foundation itself cracking? Are you telling me a company on the brink of bankruptcy is a buy? The Z-score is a useful diagnostic tool, I'll give it that, but it's a formula, not a prophecy. It's a snapshot based on historical data. It can't see intent. It can't see proactive financial management. It's a rear-view mirror, and we need to be looking at what the driver is doing right now. And this slide right here builds the counter-argument. Let me ask you this. Does a company on the verge of bankruptcy use its cash to pay off $219 million of its debt early? No. Alcoa is actively deleveraging. They're reinforcing the structure. They ended the quarter with a strong cash balance of $1.4 billion. That's a huge buffer. The Z-score is a yellow flag raised by a computer model, but management's actions, paying down debt ahead of schedule, keeping a strong cash position, that's a green light for financial discipline. So, they dodged a bullet in Q1. The story was operational hurdles masking some really strong profitability in one key segment, with a balance sheet that looks stronger than some of the metrics suggest. Okay, but what about Q2? Is the other shoe about to drop? Their guidance basically tells the same story. The divergence continues. So, step 1, the alumina segment is expected to see a $15 million unfavorable impact from lower prices and higher energy costs. The pressure is still on. But step 2 is the crucial part. The heavy lifting from the aluminum segment is projected to deliver a $55 million favorable impact thanks to those delayed shipments finally coming through, sustained higher premiums, and lower costs. It more than offsets the weakness. Okay, so the strong get stronger and the weak stay weak, but the strong part is winning. What about other pressures? I see Section 232 tariffs mentioned here, an expected cost increase of around $35 million. That's not insignificant. Correct. And that's a key variable to watch. But notice they also expect a $20 million tailwind from lower alumina costs filtering into the aluminum segment. And most importantly, they successfully completed the restart of the San Ciprián smelter in Spain back in April. This removes a major operational drag on the entire system and should contribute positively to production volumes and lower costs moving forward. It's another piece of the foundation being solidified. So, we've hammered on the weak points, we've measured the load-bearing columns, and we have stress-tested the foundation. After all of that, what's the verdict? So, is this a diamond in the rough, or is it just a lump of coal? The market's initial reaction was brutal and it was swift. But digging deeper, we've seen incredible profitability in the core business, a clear tale of two segments, and a disciplined management team making some really smart moves with their cash. It really comes down to weighing the very real risks against the hidden strengths.
This is the final breakdown. Let's look at the bear case, the cracks in the armor. It's entirely focused on the surface-level data and external risks, the revenue and EPS miss, the weak money-losing Illumina segment, that significant drop in shipment volumes, the scary Altman Z-score, and the general volatility of commodity markets. It's a case built on fear and headlines. And the bull case, the foundation of steel, is built on the idea that the market is just completely missing the real story, that the surging profitability, with net income nearly doubling, is the true signal, that the dominant performance of the aluminum segment is the real engine of this company, and that the disciplined debt reduction and strong cash position are more than enough to weather the storm in the alumina segment. Exactly. The market sold the headline. The smart money analyzes the footnotes. In our view, the cracks the market saw are superficial. The operational issues, the cyclone, the shipping disruptions, those are temporary timing issues. Meanwhile, the profitability drivers in the aluminum segment are robust and are actually benefiting from the current geopolitical landscape. The foundation, supported by that $1.4 billion in cash and active deleveraging, is solid. So for Iron Financial, this looks less like a trap and a lot more like an opportunity created by a market that just can't see the steel for the rust.
That's our take. Now, is Alcoa a buy? That's for you to decide. But we've given you the tools to look past the headlines and see the steel for yourself. Always, always do your own diligence. But when we stress test Alcoa, we find a structure that is built to last. Thanks for tuning into Iron Financial. Now you have the tools to look past the headlines and analyze the foundation for yourself. We'll see you next time.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional.